The recent failure of two banks, which had unique features but caused some stress more broadly, were an example of how the Federal Reserve, with the backstop from Treasury, immediately goes in and provides liquidity to ensure that there aren't broader risks. Since we've done that, what you've seen is bank stresses have moderated. They've stabilized. So let me separate liquidity into two things because I want to make sure that everyone here understands. The Fed's action, backstopped by the Treasury, was meant to provide liquidity to banks so that they didn't have any liquidity stresses. And so that's done, and that's what is working well. The other side is that banks are just looking at, they're just a business like every other business, and they look at, how much can we lend and feel comfortable with our liquidity and our balance sheet, and that's going to contract. And I think this is just, when you ask where have things gone, this is just part of the transition that happens when the economy goes from very rapid growth to slowing. What is, I think, we're all trying to figure out after the pandemic, the dynamics are working as we expect, but they're just working in different ways. We go from everything's, think of the pandemic, we go from, oh my gosh, we're in a terrible ditch, to we're booming. And now we're going from, okay, we're lending, we're growing, and now the slowing is coming. But that's pretty consistent with that 12-month time frame I gave you. Started raising interest rates, started talking about raising interest rates more. This is when it starts to happen. I think of this as just part of the natural dynamics of how an economy slows. It can be challenging, but this is how we get back to price stability.